This LOS is evaluate whether a security, given its current market price and a value estimate, is overvalued, fairly valued, or undervalued by the market. Okay, before we jump into this LOS, we're going to go through a bit of an introduction, and this is quite important with regards to the concept here of intrinsic value. So analysts gather and process information to make investment decisions, including buy and sell recommendations. What information is gathered and how it is processed depend on the analyst and the purpose of the analysis. Technical analysis uses such information as stock price and trading volume as the basis for investment decisions, and we saw that back in the LOS in the quant section. Fundamental analysis uses information about the economy, industry, and company as the basis for investment decisions. Examples of fundamentals are unemployment rates, gross domestic product, GDP growth, industry growth, and quality of and growth in company earnings. So this reading and the next few LOSs introduces equity valuation models used to estimate the intrinsic value, synonym fundamental value of a security. And I put this in bold here. This is really important. Intrinsic value is based on an analysis of investment fundamentals and characteristics. The fundamentals to be considered depend on the analyst's approach to valuation. In a top-down approach, an analyst examines the economic environment, identifies sectors that are expected to prosper in that environment, and analyzes securities of companies from previously identified attractive sectors. In a bottom-up approach, an analyst typically follows an industry or industries and forecasts fundamentals for the companies in those industries in order to determine valuation. Whatever their approach, an analyst who estimates the intrinsic value of an equity security is implicitly questioning the accuracy of the market price as an estimate of value. So that's the key point too that we put in bold here, is that the intrinsic value is the result of an analysis by an analyst, and you're comparing that to the market price, okay? And if there's a difference, it means that if the analyst is right, then there's been a mispricing in the security, okay? So valuation is particularly important in active equity portfolio management because you're looking for these mispricings, which aims to improve on the return-risk trade-off of a portfolio's benchmark by identifying the mispriced securities. So we're going to continue with a bit of an introduction. Really, this is my own introduction to put this reading and the next few LOSs into more context. So recall back from the Portfolio Risk and Return Part 2 and from other sections in the CFA that we studied the CAPM model. And recall the formula for the CAPM, that the expected return equals the risk-free rate plus the beta times the expected return of the market minus the risk-free rate, which is the equity risk premium, market risk premium, okay? So remember that, recall the CAPM and the security market learning outcome statements was explain the CAPM model, including its assumptions in the security market, calculate and interpret the expected return of an asset using the CAPM, and demonstrate and describe applications of the CAPM and the security market line. Well, what I wanted to point out here is that we want to be careful with this wording in terms of the expected return, because what we're talking about really with regards to the CAPM model, that's a required return, okay? And then we're going to forecast, compare the forecast return of the security versus the required return and determine whether there's a mispricing, whether the security is fairly valued, undervalued, or overvalued, okay? So remember the wording there, potential investors can plot a security's expected forecast return and beta against the security market line, which is the required return. That's what we're doing with the CAPM, okay? And use this relationship to decide whether a security is overvalued or undervalued in the market. And we've done this before. We did this in portfolio management, okay? Equity section comes after portfolio management. But if you're studying the equities first, then here's a forecast of what's coming up in the portfolio management, okay? So recall, when we did those problems in portfolio management, we were given the stock's expected price and dividend in 1 year. Remember that? In a lot of those questions, given the expected price and dividend in 1 year, we then calculated that forecast return and compared it to the required return or the expected return using the CAPM. And then if the forecast return was less than the required return, then the stock was overvalued. Okay, so that should be a little bit of a review. So what I'm saying is we're moving into this section. Where did those expected prices come from? We were given those expected prices and dividends in 1 year. Well, it's this chapter on the equities that starts to introduce us to security valuation used to calculate the intrinsic values. And so very quickly, this is a preview. V1, the value of the security 1 year from now, if you're using the Gordon growth model, constant growth, equals D2, the dividend in period 2, divided by R minus G or K minus G, okay? So then we would calculate the return as V1 minus V0 plus the dividend divided by V0, which is ending price minus beginning plus the dividend divided by the beginning price, okay? And that would give us the forecast return that we compare to the CAPM expected return, which I like to call the required return, okay? So we're a little bit careful with regards to our wording in terms of forecast, expected, and required. CAPM is clearly the required return. That's how we draw the security market line. And then we're going to calculate a forecast return. Back in the reading on CAPM, they were giving us the expected price. But now as we move into this section on the equities, we're learning how to calculate that expected price. And that's calculating the intrinsic model based on some of the, depending on which model we're using, but calculating the intrinsic value based on the model, okay? So this last thing here on this slide is the ability to benefit from identifying a mispriced security depends on the market price converging to the estimated intrinsic value. The expected price in 1 year in the CAPM problems was using the estimated intrinsic value in 1 year. If the stock was undervalued today, then the forecast return would be greater than the required or expected CAPM. Okay, so I hope that helps you put into a little bit more perspective the concepts of CAPM, which is a required return, and then comparing it to the forecast return. And how do we get that forecast return? We're going to calculate the intrinsic value based on the analyst model and the inputs to that model. Estimated value and market price. The price of a financial asset is often determined using a present value of future cash flows approach. The value of the financial asset is the expected future price plus any interim payments such as dividends or coupon interest discounted at a rate appropriate for the risk assumed. Such a definition presumes a period of time over which an investor anticipates holding an asset, known as the holding period. The investor forecasts the price expected to prevail at the end of the holding period, as well as any cash flows that are expected to be earned over the holding period. He or she then takes the predicted future price and expected cash flows and finds their current value by discounting them to the present. Thereby, the investor arrives at a fundamental value for the asset and will compare that value with its current market price. Based on any differential relative to the cost of trading and his confidence in his or her valuation model, he or she will then make a decision about whether to trade. Continuing with estimated value and market price, by comparing estimates of value and market price, an analyst can arrive at one of three conclusions. The security is undervalued, overvalued, or fairly valued in the marketplace. If the market price is less than the estimated value, then the asset is undervalued. If the market price is greater than the estimated value, then the asset is overvalued. For security valuation to be profitable, the security must be mispriced now and must converge towards the intrinsic value in the future. Market price is more likely to be correct when a security is followed by many analysts, and market price is more likely to be correct if markets are very efficient, therefore. So we'll just finish this LOS with two practice questions. An analyst finds that nearly all companies in a market segment have common shares which are trading at market prices above the analyst's estimate of the share's value. This market segment is widely followed by analysts. Which of the following statements describes the analyst's most appropriate first action? A. Issue a sell recommendation for each share issue. B. Issue a buy recommendation for each share issue. Or C. Re-examine the models and inputs used for the valuations. Okay, this is an interesting question. I think some people might answer A, issue a sell recommendation for each share issue. But recall in the question it says that nearly all companies in a market segment have common shares which are trading at market prices above the analyst estimate. This is the analyst estimate. And the market segment is widely followed by analysts. Okay, so in fact, the C is correct. The analyst should re-examine the models and inputs used for the valuations. It seems improbable that all the share issues analyzed are overvalued, as indicated by market prices in excess of estimated value, particularly because the market segment is widely followed by analysts. Thus, the analyst will not issue a sell recommendation for each issue. The analyst will most appropriately re-examine the models and inputs prior to issuing any recommendations. That goes a little bit back to the ethics as well. Obviously, a buy recommendation is not an appropriate response to an overvalued security. Again, I just copy-pasted from the previous slide. If the market price is greater than the estimated value, the asset is overvalued. One last practice question to finish this LOS. An analyst, using a number of models and a range of inputs, estimates a security's value to between 250 yen and 270 yen. The security is trading at 265 yen. The security appears to be A, overvalued, B, undervalued, or C, fairly valued. Okay, a fairly easy question, but just need to be a little bit careful. So the analyst estimate, and sometimes we do see ranges, is between 250 to 270, and it's trading at 265. Well, clearly 265 is greater than 250, and it's less than 270, so C is correct. The security's market price of 265 yen is within the range estimated by the analyst. Therefore, the security appears to be fairly valued. It's neither overvalued nor undervalued. It's fairly valued. And that's the last slide for this LOS. Thank you.